I've spent decades watching how money moves, how boards react under pressure, how institutions hold steady when individuals don't. In markets, in business, in government, the pattern is always the same. Trust is slow to build and fast to lose. And when trust slips, capital doesn't argue. It quietly reprices the world. Minutes ago, another unthinkable moment moved from rumor to procedure. Not a speech, not a rally, not a headline designed for outrage. A mechanism, a set of levers inside the constitutional machine oversight tools, emergency language, accelerated pathways being discussed, as if time itself has become a risk factor. Over the last 72 hours, the signals have tightened, sudden disclosures, sudden denials, sudden institutional motion. That doesn't wait for anyone to feel comfortable. This is different. Most people are misunderstanding this. They're treating it like a personality story, like a partisan episode, like a scandal that burns hot and then burns out. They're watching faces and ignoring plumbing. But I've learned, not as a Democrat, not as a Republican, that the real story is never the noise at the top. The real story is what stress does to systems beneath it, rules, incentives, accountability, and the fragile confidence that keeps the whole structure standing. When I look at moments like this, I don't start with personalities. I start with mechanisms. That's what decades in markets teach you. Companies don't fail because one executive makes a bad speech. They fail when governance breaks, when oversight stops working, when risk accumulates silently inside the system. This is not political. This is structural. At its core, the American system is an institutional machine designed to assume human imperfection. The Constitution is not a document of trust in leaders. It is a document of distrust, carefully engineered distrust. Separation of powers, checks and balances, staggered terms, layered oversight. These are not ideals. They are risk controls. The founders understood something every experienced investor understands. You don't design systems for good behavior. You design them for stress. In corporate governance, we accept this without controversy. Boards exist because management cannot oversee itself. Audit committees exist because financial reporting cannot rely on goodwill. Independent directors exist because concentration of power, even in competent hands, eventually leads to blind spots. None of this is moral judgment. It is structural necessity. Government works the same way, whether people like to admit it or not. Congress is not there to be efficient. It is there to be friction. Courts are not there to be fast. They are there to be final. Executives are not there to be trusted. They are there to be constrained. When those constraints start activating at unusual speed, that alone is a signal worth studying. This is not political. This is structural. Emergency language matters. In law, words like immediate, extraordinary, and clear risk are not rhetorical flourishes. They are thresholds. They exist precisely because systems must be able to shift modes when baseline assumptions fail. Think of it like a company invoking a poison pill or calling a special board session. You don't do that because you're bored. You do it because normal cadence no longer protects the enterprise. Over the years, I've watched dozens of companies reach this stage, usually not in public, usually quietly. The pattern is consistent. First, internal processes start bypassing review. Then reporting becomes inconsistent. Then oversight bodies escalate language. Finally, timelines compress. What once took months suddenly happens in days. Not because people are emotional, but because delay itself becomes risk. This is not political. This is structural. Consider the logic of oversight in any complex organization. Authority flows downward, accountability flows upward. When that loop breaks, when authority expands but accountability resists, the system compensates elsewhere. In corporations, that compensation comes from boards, regulators, lenders. In governments, it comes from legislatures, courts, and constitutional provisions most people rarely think about until they activate. The stress we're seeing is not about disagreement over policy. Systems are built to absorb disagreement. What they are not built to absorb indefinitely is ambiguity over process. Who decides, under what authority, with what review? Markets don't care what the answer is. They care that there is one. This is where people often get confused. They assume oversight escalation means collapse. In my experience, the opposite is often true. Escalation is how systems attempt to save themselves. When internal controls detect anomalies, alarms are supposed to trigger. If they don't, that's when you should worry. This is not political. This is structural. Think about the Constitution the way you'd think about a corporate charter. It defines roles. It limits powers. It anticipates failure modes. impeachment, emergency sessions amendments, these are not signs of weakness. They are clauses written for worst-case scenarios. You don't judge a system by how it behaves in calm weather. You judge it by whether it has instructions for the storm. What makes this moment unusual is not that those instructions exist. It's that multiple instructions appear to be considered simultaneously. In business terms, that's like a board reviewing CEO removal, regulatory disclosure obligations, and liquidity backstops at the same time. It tells you the system is running stress tests in real time. This is not political, this is structural. Another misunderstanding I hear constantly is that speed implies recklessness. Sometimes it does, often it doesn't. In markets, delayed response can be more dangerous than decisive action. If a bank waits too long to recognize losses, the losses compound. If a board waits too long to intervene, value evaporates. The same logic applies to institutions. Delay is not neutral. It has a cost. And cost is what institutions are designed to minimize, not in emotional terms, but in systemic ones. Loss of credibility, loss of procedural legitimacy, loss of predictability. These are balance sheet items, even if they don't appear on financial statements. I've said this many times in other contexts. Trust is an asset. It compounds slowly, but it depreciates fast. Institutions exist to protect that asset, even when doing so is uncomfortable. And especially when it is uncomfortable. This is not political. This is structural. Notice what is not happening, at least so far. We are not seeing spontaneous rule changes. We are not seeing suspension of law. We are seeing arguments about which existing mechanisms apply. That distinction matters. In fragile systems, rules are abandoned. In stressed but functioning systems, rules are contested but still referenced. That may sound like a small difference. It isn't. In markets, the difference between repricing and panic is exactly that. Panic is when rules disappear. Repricing is when rules are still there, but assumptions change. Right now, we are watching assumptions being challenged. Assumptions about pace, about deference, about how much deviation a system can tolerate before it activates its safeguards. That process is uncomfortable to watch, but discomfort is not dysfunction. Over decades, I've learned to separate noise from signal. Noise is what people say. Signal is what systems do. Systems don't get angry. They don't seek revenge. They respond to incentives and constraints. And right now, the response we're seeing is the system reminding itself, and everyone watching that authority is conditional. That's not a judgment. It's architecture. This is not political. This is structural. No final conclusions can be drawn at this stage, and anyone offering them is guessing. Processes once initiated still have to run. Thresholds still have to be met. Evidence still has to be evaluated. Outcomes remain uncertain, but uncertainty does not mean absence of structure. It means structure is doing its work under load. And under load is when you learn what a system is actually made of. When institutions come under stress, markets react before narratives catch up. That's not cynicism. That's function. I've watched this pattern repeat across decades and across continents. Markets don't wait for press conferences. They don't wait for moral clarity. They respond to probability, to variance, to uncertainty entering places where it wasn't priced before. Markets don't lie. They also don't panic by default. Panic is rare. What people often call panic is usually repricing, and repricing is rational. In moments like this, the first thing I watch is not headlines, but correlations. Stocks against bonds, bonds against currencies, volatility against liquidity. When correlations shift, it tells you that investors are reassessing not outcomes, but assumptions. Assumptions about continuity, about process, about whether tomorrow will look broadly like yesterday. Markets don't lie. Equity markets are often the loudest, so they attract the most attention. Indices move, commentators react, explanations get stapled on after the fact. But equities are only one layer. They are sentiment sensitive and forward-looking, but they are also noisy. What matters more, especially in institutional stress, is what happens underneath. Bond markets speak in a quieter voice, but with far more discipline. When yields move without central bank action, that's not speculation. That's risk being repriced. The question being asked is simple. What premium do we now require to lend to this system, given what we know and what we no longer assume? That question has nothing to do with politics. Markets don't lie. Then there's currency. Reserve currency status is not a trophy. It's a habit. It exists because millions of decisions repeated daily assume stability, enforceability, and predictability. The dollar didn't become dominant because America was perfect. It became dominant because America was reliable enough, often enough, for long enough. When currency markets twitch in moments like this, they are not forecasting collapse. They are testing resilience. They are asking whether this episode is noise or signal, whether it resolves within the system or spills beyond it. That distinction matters enormously. Markets don't lie. Capital flows are even more revealing. Large pools of capital, pension funds, sovereign wealth funds, insurance reserves don't move quickly. They don't chase headlines. They rebalance slowly, methodically, often invisibly. But when they do, it's rarely about ideology. It's about governance risk. Governance risk is the hardest risk to model and the hardest to hedge. It's not about earnings. It's not about inflation. It's about whether the rules of the game remain stable enough to justify long-duration commitments. When governance risk rises, capital shortens its horizon. It demands liquidity. It demands optionality. And that changes pricing everywhere. Markets don't lie. This is why I've always said that markets react to institutions, not individuals. CEOs come and go. Presidents come and go. But when investors start questioning institutional continuity, how decisions are made, how disputes are resolved, how power transfers, that's when behavior changes. And behavior is everything. Under uncertainty, investors don't ask, what do I believe? They ask, what could go wrong? That shift alone increases the cost of capital. Not because anything bad has happened yet, but because the distribution of possible outcomes has widened. That's not fear. That's math. Markets don't lie. Look at volatility. Volatility is not emotion. It's insurance pricing. When volatility rises, it means more people are willing to pay for protection, not because they expect disaster, but because they can't confidently rule it out. In healthy systems, volatility spikes briefly and settles. In stress systems, it stays elevated even if prices stabilize. That persistence is what I watch for. Then there's the global lens. International investors don't experience American politics the way Americans do. They don't have cultural context. They don't have emotional attachment. They look at the United States the way they look at any system, as a jurisdiction where capital is placed under a specific legal and institutional framework. When that framework appears stressed, even temporarily, they don't argue with it. They diversify. Diversification is not a vote of no confidence. It's a hedge. But hedges, when widely adopted, have consequences. Demand for alternative assets increases. Currency exposure shifts. Funding costs adjust. None of this happens overnight. It compounds. Markets don't lie. This is where reserve currency discussions often go wrong. People think in binary terms, dominant or collapsed. Reality is gradual. Reserve status erodes at the margins first, through invoicing choices, through settlement preferences, through reserve composition adjustments that look insignificant in isolation. Over time, those margins add up. Cost of capital follows the same path. It doesn't spike suddenly unless there's outright crisis. It drifts upward as uncertainty becomes embedded. Borrowers pay a little more. Issuers accept slightly worse terms. Governments roll over debt at marginally higher rates. Each step seems manageable. Together, they change the growth equation. Markets don't lie. What's important to understand here is that none of this requires an outcome. Markets are not waiting for a verdict. They are reacting to process risk, to the fact that multiple institutional pathways are being tested at once, to the possibility that resolution, whatever it is, may not be quick or clean. That possibility alone has a price. I've seen this before, not in identical form, because history doesn't repeat exactly, but in pattern. In moments when investors realize that what they assume to be background infrastructure has moved into the foreground, when plumbing becomes visible, when governance becomes a variable, when that happens, markets adjust posture. They don't flee. They recalibrate. Markets don't lie. And this is where I'll caution against overinterpretation. A market move is not a moral judgment. A sell-off is not a referendum. A currency shift is not an obituary. Markets are adaptive systems. They test, they probe, they retreat, and advance. The real signal is not direction, it's sensitivity. When small pieces of information cause outsized reactions, that tells you confidence is thinner. When markets demand more confirmation before committing, that tells you trust is being rationed. When capital prefers flexibility over yield, that tells you risk perception has changed. None of that is permanent, but none of it is free. Markets don't lie. If institutions demonstrate coherence, clear process, credible resolution, visible adherence to rules, markets will respond. Not out of loyalty, but out of logic. Risk premiums compress when uncertainty resolves. Capital lengthens its horizon when governance proves durable. That's how it's always worked. But if ambiguity persists, if process appears inconsistent, if outcomes feel contingent rather than rule-based, then repricing becomes the new baseline. Not dramatic, not catastrophic, just different. And different compounds. I'm not here to predict which path we take. I've learned the hard way that prediction is less valuable than observation. What matters is recognizing what markets are actually reacting to rather than what we wish they were reacting to. Markets don't lie. They are telling us quietly but clearly that this moment is being logged as institutional risk, not a spectacle, not a scandal, as a test of process. And tests once administered are remembered. I've seen this kind of moment before, though never in exactly the same form. History rarely repeats cleanly. What it does is rhyme softly at first, then more clearly over time. The danger in moments like this is not what happens immediately. It's what begins to accumulate quietly once the moment passes. Risk rarely arrives all at once. It compounds. In investing, the most damaging losses are not caused by a single bad year. They are caused by small deviations that persist. A little more leverage, a little less discipline, a few corners cut because nothing bad happened last time. Over years, those decisions stack. Eventually, the system looks stable right up until it isn't. Institutions erode the same way. No constitution collapses in a day. No market loses credibility overnight. What happens instead is subtler. Exceptions become precedents. Emergency measures become familiar tools. Extraordinary language becomes ordinary vocabulary. Each step feels justified in isolation. Together they reshape expectations. That's what I pay attention to. I've lived long enough to remember when trust in American institutions was treated as a given, not because people were naive, but because processes were predictable. Disputes were resolved within known lanes. Power changed hands without improvisation. That predictability lowered the cost of doing everything: borrowing, investing, cooperating. When predictability weakens, costs rise. Not suddenly, gradually. Institutional erosion is not about intent. It's about friction. When systems have to work harder to achieve the same outcome, efficiency declines, oversight expands, legal complexity grows, decision-making slows. None of this feels dramatic. It just feels heavier. Over 5 years, that weight is manageable. Over 10, it alters behavior. Over 20, it changes what a system can realistically sustain. I've studied enough history to know that great systems don't fail because people stop believing in them. They fail because people stop relying on them. They build workarounds. They hedge. They diversify away, not out of protest, but out of prudence. That's how institutional relevance fades. I remember conversations from decades ago about other countries' stable, sophisticated systems that slowly priced themselves out of trust. Nothing collapsed. Life went on. But capital flowed elsewhere. Influence softened. Options narrowed. It was all very civilized. By the time leaders noticed, the compounding had already done its work. This is why precedent matters more than outcome. Outcomes are singular. Precedents replicate. The question institutions always face in moments like this is not what happens now, but what does this teach the system to expect next time? Markets are especially sensitive to that lesson. If stress leads to clarity, clear rules, clear authority, clear resolution, confidence repairs, slowly but meaningfully. If stress leads to ambiguity, to overlapping authorities, to contested legitimacy, then uncertainty embeds itself, not loudly, persistently. I don't measure institutional health by optimism. I measure it by whether systems can absorb strain without redefining themselves every time pressure appears. Flexibility is strength. Improvisation is not. There's a difference. I've also learned that hope is not the same as assurance. It's reasonable to believe that resilient institutions can emerge stronger from stress. That has happened before. But resilience is not automatic. It depends on restraint as much as action, on remembering why constraints exist in the first place. Power always wants to move faster than process. Markets always want resolution. Institutions exist to slow both down just enough to protect the long term. When that balance holds, compounding works in your favor. When it doesn't, compounding works against you. What happens next will not be defined by a single decision or a single vote. It will be defined by how consistently the system honors its own architecture under pressure. Whether rules are applied because they are rules, not because they are convenient. I don't see inevitability here. I see probability ranges. There is a path where this moment becomes a reminder of institutional strength, a stressful episode that ultimately reinforces norms and lowers future risk. There is also a path where it becomes another data point in a longer story of gradual erosion, where each response slightly widens the margin of uncertainty. Both paths remain open. At my age, I've learned to be cautious about certainty. Systems are complex. Outcomes depend not just on design, but on behavior, on whether enough people in enough positions of responsibility choose continuity over impulse. I remain neither alarmed nor reassured. I'm attentive because, in the end, institutions don't announce when they are weakening. They show it in small ways: higher premiums, shorter horizons, more hedging, more lawyers, more contingencies. By the time those signals feel obvious, the compounding is already well underway. That's the lesson long observation teaches you. Not as a Democrat, not as a Republican. As someone who has watched trust built, slowly tested, often and lost when people assumed it would always be there, I hope this moment resolves in a way that restores confidence rather than redistributes doubt. I can see how that could happen. I can also see how easily it could not. And that uncertainty itself is the point.